Good afternoon, everyone. Today we are going to discuss chapter 14, and the title of this chapter is called Partnership Liquidation. So what is the meaning of liquidation? Liquidation means today is the last day, we are going to close our business. The partners decided not to continue their business. Okay, partners decided not to continue their business. That means today business is going to close, and how we can record accounting journal entries or some schedule based on the partnership liquidation, we are going to learn. So today we are going to learn mainly called the partnership liquidation, and the method we are going to learn is called simple liquidation method. So we have several methods, but today's class is about simple liquidation method. So how to solve this kind of method? First, step one said that selling non-cash assets. Selling non-cash assets. So who are the non-cash assets? Do you know anyone who is the non-cash assets? Except cash. Okay, except cash. All other assets are called, okay, except cash, all other assets are called the non-cash asset. So what we are doing first, because today is the last day of the business, so we are going to sell all of our non-cash assets, right? So after selling non-cash assets, we have to recognize whether we have any gain or whether we have any loss. Just simply think that if you sell your asset, you might have some gain or you might have some loss, or sometimes you don't have any gain, any loss. Okay, so we have three situations. We sell our asset, we may have gain or loss, or we may not have gain or loss. So we have to calculate whether we have any gain or loss. Okay, if no gain, no loss, then we no need to consider anything. We no need to consider anything. But if we have a gain or loss, then we have to allocate. We have to allocate this gain or loss to the partner's capital account, to partner's capital account. Partner's capital account. That means we are the partners, we are the owner, right? If we have any gain, it is our gain. If we have any loss, it is our loss. And we know that in the partnership business, chapter 13, we know that all gain or loss or profit or loss, we are going to adjust with our capital account. If we have a gain, it means that our capital will increase. If we have a loss, it means that our capital will decrease, right? You know this information. So first we are going to sell our non-cash assets. And when we sell our non-cash assets, we have to immediately recognize we have gain or loss. And this kind of gain or loss is going to allocate to the partner's capital account based on the income ratio. So based on income ratio means when we form the business, we already know what is my percentage of the profit, what is your percentage of the profit. We already know that, right? So based on this income ratio, we are going to allocate our gain or losses. Now, whenever we have available cash, we have to pay our liabilities. We have to pay our liabilities. It means that as a partners, we are the owner. So we cannot receive money before we pay the liability. Okay, after paying. So today is the last day. We have to pay all of our liabilities. After paying liabilities, if we have cash, then as an owner, we can receive this money. Do you understand? So before receiving cash from the business, we should pay all of our liabilities. And we have to remember that we should have enough cash. Okay, we should have enough cash to pay the liabilities. Anyway, we should have enough cash to pay the liabilities. Then distribute remaining cash. Remaining cash means after paying liabilities, right? After paying liabilities. After paying the liabilities, remaining money goes to the partners. Remaining money goes to the partners. And when remaining money goes to the partner, we have to follow the capital balance ratio. Capital balance ratio. That means after paying the liabilities, we have to calculate what is the present capital ratio. Okay, because capital ratio is always changing. Why capital ratio is always changing? Because you sometimes have gain, you sometimes have loss. Okay, so capital balance is changing. So after paying the liabilities, we have to find out what is the latest capital balance, and based on the latest capital balance, we are going to pay the remaining cash. So you have to consider these steps. I repeat again: sell non-cash asset, receive cash, and immediately recognize gain or loss, and allocate this loss or gain to the partner's capital account based on the income ratio. Then we have to pay all of your liabilities, and after paying the liabilities, remaining cash goes to the partners based on their capital balance. So this is the simple process. Okay, but the real business world is not so simple like that. So we'll learn another method later on called the installment method. Maybe next class we'll learn this. So let's see how to handle the simple liquidation. Read this question. P, T, and Z have operated a business for 10 years, right? So we have three partners, P, T, and Z. This is the important point. The partners who shared their profits, 433, right? 433, this is the profit sharing ratio. Here P for 4, T for 3, and Z for 3. The partners decided to liquidate their business. That means they decided not to continue the business. Okay, they decided we are not happy with our business maybe, so we have to liquidate our business anyway. So today they are going to liquidate. Now the firm's balance sheet just before, the partners sell other assets for $30,000 is as follows. Now you have to remember that this is the market price. This is the market price. That means this amount is called fair market value. Fair market value. This is the fair market value. That means companies sell asset, okay, and receive cash. So if this is the case, you have to know this formula. So fair market value, if fair market value is greater than book value. So which one is the book value? This is the book value, $110,000. $110,000 is the book value, right? So $110,000, we find that this is our non-cash asset and this is the book value, and we sell this asset. Okay, we sell this asset for how much? We sell this asset for $30,000. So here we see that our fair market value. So this is not the situation. If this is the case, if fair market value is higher and book value is lower, it means that we have a gain, right? We have a gain. But if fair market value is lower than the book value, that means that we have a loss. We have a loss, right? So this is the formula to recognize gain or loss. So we know that book value is $110,000. So book value, we are here. Book value is, fair market value is $30,000. $30,000, and it is lower than the book value is $110,000. That means $80,000. $80,000 is the loss, right? You understand? $80,000 is the loss, and this loss is going to share. This loss is going to share 433, right? And you know that we transfer this loss to the capital account. And when we transfer this loss to the capital account, look at their capital balance. This is the capital balance, right? Their capital balance will decrease. Their capital balance will decrease. So this is the asset. This is the balance sheet before selling, before liquidation. Cash $15,000, non-cash $110,000. So they have liabilities $42,000. This is the liabilities, and this is their capital balances at this moment, and this is the total liabilities and equity. So this is the first part of the question. Okay, this is the first part of the question. There are three partners. They shared their ratio of 433. They are going to liquidate their partnership. That means they are going to close their partnership, and they sell all of their non-cash assets for $30,000. And we know these are the assets and these are the liabilities and capital. Now you can see that this is the personal status. Okay, this is the personal status of their asset and liability. So what is the meaning of personal status? This personal status means it is not related with the business. So business information is here. Do you understand? This is the business information, but this is the personal information of the three partners. P has asset, personal asset. Okay, this is the personal asset, $55,000, and the liability is $80,000. So this is personal asset. This is personal liability. Okay, so it is a good news or bad news for P. Your asset is $50,000, but your liability is $80,000. Okay, you have a good news or bad news? Bad news, right? So $25,000 is negative. This is the bad news. Bad news means actually you are called insolvent. So if you have more liability than your asset, so you are the insolvent. Okay. So this is personal information, not the business. So why we need personal information, I will explain very soon. What about T? T personal asset $30,000, but personal liability is $10,000. So it is a good news, right? So $20,000 is a good news. $20,000 is the good news because he is solvent. Okay, he is financially solvent. What about G? G assets $30,000, but liability $50,000. So again, bad news, right? Bad news. $20,000. Bad news. $20,000. So we should consider this good news or bad news. We should consider this good news or bad news. Why we need to consider this good news or bad news? Because if in future there is any capital deficiency, for example, I have capital deficiency. For example, I am Tom. For example, I am Tom. Okay, and I have the capital deficiency in the business. So if this is the case, as I am solvent, I can easily receive, collect some money from my personal asset and give it to the business. Do you understand? According to this information, Tom is solvent, right? Tom is solvent. So if Tom has any capital deficiency in future, he has the ability to bring personal cash and give it to the business. But look at what about Jack. At this moment, if we compare Tom and Jack, for example, we are going to compare Tom and Jack. Okay, Jack is completely insolvent, right? Because he don't have the ability to bring personal cash if he has capital deficiency. And what is happened to the P, we'll see later on. Okay, we'll see later on who has the ability or not. But according to this situation, Tom is in better situation. Tom has the ability to survive. Tom has the ability to survive because his asset is higher, personal asset is higher, and personal liability is lower. So this information we need later on, we will see why we need. Now we are going to solve this question. So I already sent you this blank sheet with you, right? Now you should do the solution with me step by step, so that you can easily understand every step. Okay, you can easily understand every step. It's not very difficult. Try to understand and try to solve it with me. So this is the schedule. This is the partnership liquidation schedule. Okay, this is the partnership liquidation schedule, and this is cash. This is non-cash asset. So this column are the asset, right? This is actually the asset. So this is the asset part. This is our asset part. Then we have liabilities. We have liabilities. Okay. Then we have capital balances. So we can copy and paste from the question. So at this moment, we have $15,000 cash. So we can give a title that beginning balances. And we have $15,000 cash balance. From the question, we just copy and paste. We have $110,000 other asset. We have $110,000 other asset. Then what is the balance of our liabilities? Our liabilities balance is $42,000. $42,000. Then P capital is $55,000. P capital $55,000. Then T capital 14,000, and Z capital 14,000. So this is the beginning balances. This is the beginning balances. We just copy and paste from the question, right? And as we are talking about the liquidation means business is going to close, right? Business is going to close. Our ending balance. Can you guess what should be the ending balances? Can you guess? What should be the ending balance of this all accounts? 0. Okay. So it should be 0. Because we are going to close our business, right? We are going to close our business means everything should become 0. So we know our beginning balance and we also know our ending balance, right? Ending balance should be 0. So do you understand here? Now remember the simple steps, simple liquidation is that we have to sell our non-cash asset, right? We have to sell our non-cash asset. And if we sell our non-cash asset, we know how much is our asset. We sell $110,000 asset, and we know how much cash we receive, right? How much cash we receive. So look at the journal entry. So look at the journal entry here. We know that this is the book value of our asset. This is the book value of our asset. We sell it, right? We sell all of our non-cash asset. What is the meaning? Meaning is this account is going to close. Do you understand? This account is going to close. Why? Because this $110,000 is the debit, right? This $110,000 is debit. Now we record $110,000 credit. We record $110,000 credit, right? So non-cash asset is closed. And how much cash we receive? We receive $30,000. We receive $30,000, and debit and credit is not equal because cash is the fair market value. Cash is the fair market value, right? So book value and fair value we compare, we receive less money, so the remaining is the loss. Remaining is the loss. So loss is $80,000. This is the loss, right? Now, if we come here, number one, first we sell non-cash assets, right? And we find that we receive cash $30,000. Okay, we receive cash $30,000, and we sell our asset. We sell our asset. We sell our asset. Do you understand? So we sell our asset 110 and we receive cash $30,000. Now I told you that when we sell, we have to immediately recognize whether we have any gain or loss, right? And we find that we have a loss. And what should we do? We should close this loss and we transfer this loss to the capital account, right? We transfer this loss to the capital account. Clear? Now look at the journal. Look at the journal. We are before you can see that loss is debit, right? Before we find that loss is debit. Now we are going to record loss in the credit side. That means loss closed. Loss account closed, right? Loss account closed. And we transfer this loss to the capital account. And you know that loss means capital will decrease. And we know the formula. So this is the credit balance. You know that this capital is the credit balance. This is this side, right? Credit balance. This is the credit balance. So this loss is this capital is the credit. Now, if we transfer loss to the capital account, it becomes debit, right? It becomes debit. So capital increase credit and capital decrease debit. Now this $80,000 is going to share 410, 310, and the 310. Clear? So 32, 24, 24. So 32,000. 24,000, 24,000, right? So what happened? Number one, sell non-cash assets and allocate loss. Can you see properly? So we sell our non-cash asset, right? We sell our non-cash asset and we allocate loss. Now, what is the balance now? Now, cash balance is now $45,000 because our cash increase, right? Our cash increase. Now, what is the balance of non-cash asset? 0, right? It is closed. Now, what is the balance of our liability? So we calculate new balance again. So liability balance is $42,000. So what is the balance of P capital at this moment? First, he has credit balance $55,000. Now debit $32,000 because it is the loss, right? Now what is the balance here? Balance here is $23,000. Clear? What about Tom? What about Tom balance? Look at it. Tom capital credit balance $14,000, but he is going to share loss. She is going to share loss $24,000. So loss is higher than his capital, right? That means she has or he has the capital deficiency. So that means $10,000. This $10,000 is the capital deficiency. Clear? And the Jack also the same. Jack also the same capital deficiency. Right? Do you understand? Now you can see that now we have enough. If we compare our liabilities, we see that we have some cash and we have liability. And if you compare these two, now we have enough cash to pay the liability. But from the very beginning, you can see that from the very beginning, we cannot pay our liability. Why? Because our cash was $15,000 and our liability was $42,000. So at that time, we cannot, right, pay the liability. So now we have enough cash, we are going to pay our liability. So number two is payment to liabilities. So how much we are going to pay from our cash? So we are going to pay $42,000. We are going to pay $42,000. So our cash is decreasing. Our cash decreased $42,000, right? And our liability also decreased $42,000. Liability also decreased $42,000. So do you understand number two? We have enough cash. Okay, we have enough cash. Now we are going to pay our liabilities. Now, what is the journal for this? What is the journal? Our cash decrease, cash credit, right? And our liability decrease, liabilities debit. So you should, accounting student, you should know that. So this is the journal for number two. Our cash decrease, cash credit. Our liabilities decrease, liabilities debit. Right? Yes. So this is the journal for 1, and this is the journal for 2. Now, what is the balance at this moment? After doing every transaction, we have to calculate a new balance. Okay. So what is the cash balance now? $3,000. Cash balance is $3,000. We already closed. We already closed non-cash asset. Now we closed our liabilities. So liabilities debit means, you can see that liability debit means liabilities is going to close. Liabilities closed. So liabilities closed, and this is the capital balance for P. This is the capital balance for Tom. And this is the capital balance for Jack. Now the difficulties came. So we have $33,000 cash. Okay. Now our cash is lower, but capital balances are very high, right? So here $23,000 P will do not have any capital deficiency. So he can claim this money. But Tom and Jack cannot claim any money. Do you understand? Tom, according to this point here, we have $3,000 cash. This cash can only be claimed by P because P has the positive capital balance, right? But Tom and Jack, they don't have a positive capital balance. Now we are going to compare. We are going to compare Tom and Jack first because both of these two people, their capital balance is negative. Now we have to find out who is, if we compare Tom and Jack, okay, who do not have the ability to survive. Who do not have ability to survive. Tom capital, look at here. Tom beginning capital 14,000, Jack capital 14,000. They share profit and loss 30%, profit and loss 30%. Okay. Their capital balance now deficiency 10,000 and 10,000. All informations are similar, right? But can you tell me who has the ability to survive and who doesn't have the ability to survive? Who? Tom can survive, right? Why Tom can survive? Very good. Yes. Why Tom can survive? Because Tom have some personal asset. Okay, so I have personal asset. I tell you that don't worry, I have money, I am going to give you money. But Jack here is completely insolvent. Jack is completely insolvent, right? Complete. Although P is negative deficiency, right? Although P do not have enough money to pay the liability, but in the business situation, we find that P is a good situation, right? P is in a good situation. Why? Because his capital balance is positive. Although he do not have any personal asset, look at here. Although P do not have any personal asset, but from the business perspective, he is 100% safe, right? He is 100% safe. But here, Tom has the ability to bring capital from personal asset, but Jack is completely insolvent. So according to the partnership law, okay, if any of our partner is completely insolvent, so what should we do? We are the other two partners. The other two partners are going to share this loss by ourselves. For example, I am completely insolvent. I am completely insolvent. I don't have enough money to survive. Okay. Then what should you do? You two people, you said that as we are partner business and according to the law, my loss is going to share by you. Do you understand? My loss is going to share by you. So here we see that Jack is completely insolvent. So we have to make Jack account 0. Jack capital is going to close. Do you understand? Jack capital is going to close. Why we are going to close his account? Because we said that you are not going to receive any money from business because you still have the deficiency and you don't have the ability to bring money. So as this is the case, how to make it 0? Look at here. This is $10,000 is debit balance or credit balance? Can you tell me? This $10,000 within bracket, it is a debit balance or credit balance? Debit balance, right? Very good, debit balance. So if we want to make it 0, if we want to close him, what should we do? Make it credit, right? So if we put, look at here, if we put $10,000 here, if we put $10,000 here, he becomes 0, right? It means that we other two partners give him some more capital. Give him some more capital from our capital, right? So this is our capital. Look at here. At this moment, this is our capital. At this moment, this is our capital. So we are going to share our capital, okay, with Jack to make him close. So this $10,000, we give it to him and we are going to share this loss. Try to understand. We are going to share this loss here. We are going to share this loss. So look at the journal first. So we give Jack $10,000 capital, okay, from our capital. If I give my capital to you, your capital will increase and my capital will decrease, right? Same here, we two people, P and T, share $10,000 capital with Z, right? So Z capital increased $10,000. So it is credit, right? Then Z is going to closed. Z is going to closed. We said that, okay, we share some capital with you to make you 0, okay, to make you 0. Now this loss is going to share by P and T. And what is the P and T ratio? Look at here, P and T ratio is 4 and 3, right? 4 and 3. So based on this 4 and 3 ratio, we are going to share this loss. We are going to share this loss. Now our capital debit. Our capital debit means our capital is decreasing, right? So look at here. Yes, so we give some capital to Z and we share his deficiency as our deficiency. And what is the title? Number 4, number 3. So you can write a title something like this: allocate Allocate Jack's deficiency balance. Do you understand? Now, after sharing loss by P and T from Jack becomes 0, right? Now we calculate a new balance. Now we have $3,000 cash. We have $3,000 cash. Then non-cash already closed. Liabilities already closed. Then what is the P capital at this moment? P capital at this moment is 17,286. 17,286. What is the sorry? What is the Tom's balance at this moment? Also not minus. It is something like 14,286. 14,286. And we close Jack. We close Jack. Do you understand? So why we close Jack first? Try to understand. Why we closed Jack first? Because Jack is completely insolvent. Okay, Jack do not have any ability to bring cash from the business. Sorry, from his personal asset. So we close him from the very beginning. Clear? Now try to compare now P and T. P is the surviving partner, right? Because his capital is positive. His capital is positive. But T capital is still become negative, right? He was negative $10,000. Now he became more negative. Why he became more negative? Because he accepted to become more negative. Why? Because he is the totally solvent people here. T is the solvent. Because look at that, he can share loss up to $20,000, right? Up to $20,000, because this is the excess money he has personally. And this $20,000 is greater than, look at that, this 20,000 is greater than his capital deficiency, right? Do you understand? My deficiency in the business is $14,000, but in my pocket I have $20,000. So I said that don't worry, I am going to give you personal money to you. You understand? Now Tom is going to bring this money from his personal asset. You understand? Tom said that don't worry, as I have capital deficiency, it is my responsibility to give you money, right? So I have enough cash, I am going to give you this money. Now Tom invest some more money, right? And business receive this money. Business receive this money. Business receive this money. And this is called number 4. Number 4 means investment by Tom. Tom now invest more money. Investment by Tom. So business receive cash, look at here. Business receive cash and his capital is going to increase, right? If you, as a partner, as owner, if you give any money, your capital will increase. Now look at the journal for 4. Business receive cash, okay? Business receive cash 14,286 and Tom capital increase 14,286, right? After that, what is the balance? After that, what is the balance? Balance now cash become 17,286, right? This is the cash new balance, right? Then we already closed non-cash account before. We already closed liabilities account before, and this is the capital balance of P. This is the capital balance of P. Now what is the capital balance of T now? 0, right? 0, yes. So Tom also closed. So Jack closed, right? Tom closed. Liabilities closed. Non-cash asset closed. So we have remaining some cash, right? We have remaining some cash, $8,000, right? Something. And this money is enough to pay the fee money, right? You understand? Now number 5. Now number 5. Now number 5, payment to Katie. So now we are going to pay this money. We are going to pay this money. Cash is increasing or decreasing? If you pay, cash is decreasing, right? Cash is decreasing. And P received this money and he is going to close. Okay, so how to make P0? If you want to make P0, record this account debit, right? This account debit, because his balance is credit. Now we make him pay him cash and make it debit. So look at the last journal. We pay capital to Petty, so he become debit, right? And our business pay cash credit. So after that, you can see that all account closed, right? All account closed. Do you understand? Okay, let's quickly move on to the another question. So I wrote the journal entries to make it more clear to you. Okay, if you don't understand these tables in future, okay, you can watch the video again, or if you can, I will share you the video later on, and recording class later on, and you can see the journal entries also. It will help you to know the topic more easily. So we are now in exercise 2. So exercise 2, we have 2 parts, part A and part B. Okay, so first I will solve part A, then I will give you some work now later on to solve part B. Okay, so try to understand part A very well. So the partnership are X, Y, and Z. They decided to liquidate their business. So we know X, Y, and Z are the partners. They're going to liquidate today, and this is their income and loss sharing ratio. No partners, try to understand, no partners can make any payment into the partnership. What does it mean? You should understand. If you compare exercise 1 and exercise 2, what is your understanding about this sentence? No partners can make any payments into the partnership. What does it mean? So yes, it means that if there is any capital deficiency, they don't have the ability to bring personal money. You understand? Look at the previous question. According to the previous question, Jack is completely insolvent. Okay, Jack is completely insolvent, but Tom has the ability to bring personal money, right? Tom has the ability to bring personal money, but P do not need to bring any personal money. Why? Because P's capital is already very high, right? P's capital is already very high. So previous question said that some people has the ability. Some people has the ability to bring personal cash if there is any capital deficiency, right? But exercise 2 said that no person can make any payments to the partnership. That means, what is the meaning? The meaning is we have to assume that all partners are, this is our assumptions according to this question. Okay, according to this question, this is our assumptions. Assume that all partners are insolvent. If they have any capital deficiency, other partners will share this loss. Okay, for example, I have the capital deficiency. You are the partners. You have to share my loss. You cannot force me to bring my personal cash because we assume that we are insolvent. I think you understand, right? Now the partnership sold non-cash assets for $20,000. So you know that we sell our non-cash asset and this is the fair market value. Fair market value. This is the fair market value. Now we should calculate whether we have any gain or loss. Why? Because our asset value, our book value is $40,000, right? Book value is $40,000, but when we sell it, we receive $20,000. So we have a sad news, right? We have a bad news. It means that we have a loss, and we have to share this loss based on 2 to 6. Now this is the question: beginning balances. Beginning balances, and what we know? We know that the ending balances should be 0. Ending balances should be 0, right? So what is the first item? If we remember, we sell our asset, right? Sell assets and allocate loss. Sell assets and allocate loss. This is our first transaction, right? So because look at it from the very beginning, we have $5,000 cash, but our liabilities is $15,000, right? So according to this question, we can see that this is our asset. So we have 2 assets, right? We have 2 assets, and we have actually 2 liabilities. We have 2 liabilities. Try to understand. We have 2 liabilities. One liability is the outsider, creditors. Okay, these are the creditors, for example. Or I can make it short for you, accounts payable. Okay, for example, this liability is the accounts payable, for example. And we have another liability, that means Y. We have some loan from Y. Do you understand? Y is also a partner, right? Y is also a partner, but one day maybe business request Y, please give us some loan. Okay, so we have 2 liabilities. We have 2 liabilities. One is outside liabilities and another is inside liabilities. Okay, so as a partnership law, we have to pay our outside liabilities first. Do you understand? We have to pay the outside liability first. Then if we have any internal liabilities, then we'll negotiate something like this. And this is the capital balances. Anyway, this is the capital balances. Do you understand this question? We have 2 assets, right? We have 2 assets, we have 2 liabilities. One liability from outside, another liability with our partner, but we have some capital balances, X, Y, and Z. You understand the question, right? Now we sell our asset and allocate loss. So what is the asset? How much cash we receive? Yes, so we sell our asset and we receive $20,000. $20,000, and we sell our $40,000 asset. So look at here. Again, our asset book value, right? I don't want to write again and again, fair market value anyway. This is the fair market value, this is the book value. No, this is the fair market value. This is the fair market value and this is the book value. So our asset decreased $40,000. We closed it. It's closed. It is closed and we received cash $20,000. So you can easily guess that remaining is the loss, right? And how much loss? Loss is the $20,000. And this loss is going to close. This loss is going to close, right? And we are going to allocate this loss. We are going to allocate this loss to the partners. That means partners' capital is going to decrease 4,000, 4,000, and 12,000. Clear? So we are going to decrease here. Our X capital decrease 4,000. Y capital decrease 4,000 and Z capital decrease 12,000. So we shared this loss. Now what is the new balance now? $25,000. $25,000 and this is 0. We have $15,000 liability. We have $2,000 loan from Y. Now what is the capital balance? Capital balance is $8,000. And here they have a bad news, $3,000. And what about Z? Z has a good news, $3,000. Clear? So at this moment, this is the negative balance, right? But other two people still have the ability to survive. Other people still have the ability to survive, right? Now we find that we have enough money to pay the outside liability, right? We have enough money to pay the outside liability. So number 2, payment to accounts payable means liabilities. So we are going to pay our creditors, right? So how much money we are going to pay? Because we have the ability to pay the full money. So $15,000 is going to pay. $15,000 is going to pay. And our liability decrease also $15,000, right? Look at the journal entry here. Liabilities debit, or that means accounts payable debit. Accounts payable debit, and we pay cash $15,000, right? After that, what is the new balance? Now we have only $10,000 cash. We have only $10,000 cash. Non-cash asset already closed. Liability is already closed. So we record liabilities debit means liability closed. So 2 accounts already closed. 2 accounts already closed. Now we have another liability here. $8,000 is the X capital balance. $3,000 negative is the Y capital balance. And $3,000 positive is the Z capital balance, right? This is the new balance. Now we have to pay this liability, right? We have to pay this liability. Do you understand? But interesting point here is that Z already liable to business is $3,000. Capital balance deficiency means Y is liable to pay this money, right? So try to understand. I am liable to pay you $2,000. I am, okay? I means business. I liable to pay you $2,000, but you liable to give me $3,000. Do you understand? Do you understand my point? I am liable to pay you $2,000. But anyway, you are also liable to pay me $3,000. Now $2,000 is common, right? $2,000 is common. So we can offset this balance. Clear? Very easy. So number 4, you can say that. That means I no need to pay you any money actually for this $2,000. Why I no need to pay any money this $2,000? Because we can offset our loan each other. Okay, we can offset our loan each other. So we can give a title that offset loan. Offset loan. So it will not affect anything with our cash. It is not going to affect anything with our cash. So we are going to offset our loan each other. Do you understand? Now what is the balance? Still we have cash balance $10,000. We have cash balance $10,000. Our non-cash asset already closed 0. Okay, our liability is already 0, right? Now loan from Y, right, also becomes 0. Do you understand? Loan from Y also becomes 0. Now what is the journal for 4? You can see that journal for 4 I write here. So this is a 4 or 3? 3. So 3 is here. Okay, we give $2,000 to Y capital, right? To Y capital, and we said that you can offset this money from our loan. Clear? Yes. So you can see here. So as we give him some loan, we give him some capital, right? He has the capital deficiency. He has the capital deficiency, and business said that don't worry, I'm going to give you $2,000 capital, and I am not going to give you any cash. Now, what is the X capital balance? X capital balance $8,000. Now, what is the Y real loss, real capital deficiency? $1,000, right? $1,000 is the real deficiency at this moment because we offset the loan. We offset the loan. And what is the Z balance? Z balance is $3,000. Now we have some money to pay cash, right? We have some money to pay the cash, but we know that if there is any insolvent people, okay, if there is any insolvent people, we'll request him to bring cash from the business, from her personal account, right? Do you understand? But this question said that Y is completely insolvent. So Y do not have any ability to bring the money from his personal asset. Why? Our question said that no partners can make any payment into the partnership. That means all are insolvent. So according to this question, we find that actually Y is insolvent, right? Y is insolvent because other people already have positive balance. Now, as Y do not have any ability to bring personal money, what should we other people do? According to the partnership law, we said that we are going to absorb your loss. That means I am going to share capital with you. Okay, my capital will decrease and your capital will increase up to 1,000 and become close. Same, we are going to give him $1,000 here, right? We are going to give him $1,000 to make him close, right? And we are going to share this $1,000. We are going to share this $1,000, these two people together, but not equally. Okay, not equally. Why? Because we are going to compare now X and Z, right? X and Z. So X is 2 and Z is 6, right? You understand? That means 8. Now we can see here, we give some capital to Y, right? We give some capital to Y and Y became closed. Y became closed. Y became closed because we give some capital to Y, right? Now we share our capital with them, right? With Y. So our capital will decrease. So X is going to share 250 and Z is going to share 750, right? Okay, so you can see here, this is going to decrease and this is going to decrease 750, 650. So 750. Yes, 1,000. So Y already closed. Y closed. Our non-cash asset closed, right? Liabilities closed, right? Liabilities closed. So we can make a name here, number 4. So the title might be allocation of deficiency. So this deficiency we are going to allocate. Now, what is the new balance? What is the new balance? Cash, we have 10,000. 0, 0, 0. So we also closed our loan, right? We also closed our loan account. Also closed loan account. So 0, 0, 0. So what is the new balance for X now? X new balance is 7750. 7750 positive. And what is the new balance for G? It is 2250. 2250. Right? So now we have $10,000 cash available in the business, and X claim is $7750. Z claim is $2250. So we pay all our liabilities, right? We pay all of our internal liabilities, all of our external liabilities. We already sell all of our asset. Okay. Then we close Y account. Why? Because he is not going to receive any money because he is insolvent, right? And he is not going to receive any money. We close him. Now these two amount equal $10,000, right? Now we are going to pay. We are going to pay. That means payment to partners. Payment to partners. Payment to partners. So our cash is going to decrease $10,000. Our cash is going to decrease 10,000. So we are going to close his capital account, right? We are going to close his capital account. That means X capital account we are going to close, right? So if we make it debit, it is going to close. Then we are going to close. We are going to close Z capital. We are going to close Z capital. Now look at this chart. Yes. So all become 0, 0, 0, right? All become 0, 0, 0. And this is the journal. Now assume that previous question we sell $40,000 of asset and receive how much? Receive $20,000, right? Just I change a simple number. I change the simple number. We sell our asset for $16,000, not $20,000. Our asset price is book value is $40,000, but we sell it $16,000. Now we have 15 minutes time, 10 minutes time, or 15 minutes solving quickly. So this is the solution. So you can find your mistake if you have, right? If you have your mistake, you can find out your mistake by yourself. Then you can understand. Because every concept I already explained here. And you also have the journal entries for you. Okay. And if you read the journal entries, it will help you also to solve this question. Okay. And now look at the question again. So assume no partners can make any payments into the partnership, right? The same question I can change. Assume that all partners are solvent. Okay, what is the meaning? All partners are solvent. That means if they have any capital deficiency, they can bring this money from their personal account, personal business, or personal asset. Okay, so you have to understand exercise 1 and 2 very carefully. Exercise 1 said that if you are capital deficiency, you can bring this cash from your personal asset. But question 2 said that you don't have ability to bring any personal asset, right? Okay, thank you very much.